As expected, at its first meeting of 2025, the Federal Reserve kept interest rates unchanged, with the upper limit remaining at 4.5%. Moreover, the decision was made anonymously by policymakers. With the rate decision settled, all trader attention shifted to Jerome Powell's press conference. As always, investors were alerted to his assessment of the situation. As always, he was extremely cautious when discussing the Fed's future policy steps. According to Powell, the US economy remains strong overall, while inflation is still elevated. Therefore, the Fed is in no rush to adjust monetary policy, taking the wait-and-see approach. He emphasized the importance of observing Donald Trump's upcoming policy decisions and evaluating the impact on inflation and the labor market before taking action. At the same time, Jerome Powell underscored the Fed's independence from any statements made by the new administration. His measured and cautioned remarks stood in a stark contrast to Donald Trump's bold and assertive rhetoric. Trump, has his part, has already taken aim at the Federal Reserve, declaring just days ago that he will demand an immediate rate cut. When Powell was asked to comment on Trump's statement, he simply responded that he would not and that such decision was inappropriate. Moreover, Jerome Powell pointed out that the Federal Reserve is not opposed to technological innovations and that banks are allowed to provide services to cryptocurrency firms. This positive remark for Bitcoin fueled bullish sentiment, causing the flagship cryptocurrency to surge from 101,500 to 104,500. In the first half of a Thursday, crypto bulls maintained their enthusiasm, keeping Bitcoin's price steady around $105,000. As for the main fiat currency, the US dollar index surged at almost a one-week high immediately after the Federal Reserve decision. However, this enthusiasm was short-lived. By Thursday, the index had already entered a consolidation phase, trading in a narrow range below the key technical resistance of 108 points. The main driving force behind the currency market right now is the looming US trade tariffs, rather than the interest rate differential between major central banks. Moreover, since the Fed's pause is expected to be prolonged, the European Central Bank is likely to implement rapid rate cuts, starting today on January 30, followed by March, July, and possibly even December. Thus, the downtrend for the euro is becoming increasingly stable, and the rise in the euro-dollar pair within the range of 1.0406 to 1.0435 in the morning was nothing but a correction that quickly faded as soon as France and Germany released their GDP data for the fourth quarter. The leading economy of the Eurozone was at least expected to reach zero growth, according to forecast. However, this did not happen. Instead, Germany's GDP contracted to minus 0.2% year-over-year, marking its seventh consecutive quarter without growth. Meanwhile, the bears have taken control of the euro. Now the euro-dollar pair has a new target, support around 1.0375. If the price breaks below this level and closes below it today, Friday's trading could start from his points, with the downward momentum likely to continue. Unless, of course, Donald Trump decides to make yet another unexpected statement. In that case, a break above the resistance level of 1.0445 could serve as a trigger for a short-term euro buying. However, if the US imposes tariffs against the Eurozone, discussions about the euro's parity with the greenback will likely resurface. Oil traders are also closely watching the actions of the US President Donald Trump, particularly the possible introduction of tariffs against China and Canada on February 1st, the latter being a major oil supplier to the US market. Now traders are awaiting the OPEC Plus meeting on February 3, focusing on the supply plan for April. Last week, the US president urged the group to lower oil prices. Notably, yesterday's reports showed a rise in the US inventories by 3.463 barrels last year. And at the market remains in a wait-and-see mode. Oil prices are going down. Brent crude fell 1% in the previous session and is trading between $75.90 and $76.90 per barrel. The Russian ruble also saw a slight correction on Wednesday, trading between 97.20 and 99.20 per dollar. Amid tax payments by exporters in January, the national currency even reached its highest level since early October 2024. However, with the first tax period of the year now over, the ruble is expected to weaken. Besides, it has come under pressure from new sanctions risks. As the European Union authorities are ready for the 16th sanctions package, there are discussions about additional restrictions on Russian banks and a ban on the purchasing Russian gas. As a result, the ruble could see increased volatility against both the US dollar and the Chinese yuan in the coming days, especially considering that China markets are closed this week due to the Lunar New Year celebrations. So that's all for today. We continue to follow developments in the financial markets, subscribe to our channel, and follow news with us. See you!